Hey everyone, it's Imran from Options Insight, back with your macro options spotlight. Remember, like, subscribe, comment, ask questions, do whatever you like, but we want to get the algorithm passing this around so people can learn about options and learn this information. Okay, stocks recovering a bit yesterday. They had obviously pulled back, weighed down by Apple and Tesla the day before, but then we did see a bounce, although we pulled back from highs as the FOMC minutes came in. They came in hawkish, which is no real surprise. With a focus on the tight labor market, feeding into the core services inflation, and needing to stay higher for longer, and it being a bit of a consensus at the Fed that they're not going to cut rates at all this year. That's what they're saying. Still, the market doesn't seem to believe them yet, but that's what they're saying. Europe continued its recent outperformance, hanging on to 2% plus gains, and China was absolutely storming away, up 6% on the day. Gold continues to look good. Miners were up 4%, gold miners, that is GDX, and gold starting the year very positively. Oil, on the other hand, taking a beating since the start of the year, down nearly 5% yesterday. So clearly, oil is not participating in the China reopening narrative that is driving Chinese stocks higher. Oil is definitely doing something else. We did see inventory builds there in oil, but it seems like, some speculators may have piled into a bit of commodities at the end of the year, as we flagged, and maybe some of that positioning needs to get squeezed out before oil can really do what it really wants to do this year. We're still generally bullish, and we would be looking to add more exposure on dips. We're certainly not limit long here, but we do like oil for the year, and would be looking to get into more and more exposure as the year plays out, and hopefully as price action improves. Looking at volatility, vols were softer in Europe and US, down about 3/4 of a vol to a vol. Asian vols, however, were better bid. So you had a bid coming back for China on that big upside move, and also Japan and Indian vols well supported. Looking at obviously with the non-farm payrolls on Friday, with CPI next week. Once those macro catalysts pass, you would expect index vol probably to take a bit of a hit, as the focus would then shift towards single stock vol, because earnings season is going to kick off. So that's typically what tends to happen, right? Index vol kind of goes on the back burner a bit. People are selling index vol to finance owning single stock vols as they're playing all these earnings moves that they're anticipating. That's what we call dispersion trading. Oil vol did continue to trade firmer in commodities. The only real mover up nearly a vol point again, as spots starting to break down and move quite violently to the downside. Looking at carry, European carry and Asian carry, well, China especially, are pretty negative, so that they're performing pretty well so far this year. US indices, on the other hand, are still in the green, so slightly positive carry, saying that realized hasn't quite picked up yet, because US markets so far have managed to stay relatively range bound since the start of the year. Now, non-farm payrolls may well change that, as the labor market is becoming much more pivotal than, say, the headline inflation readings, which everyone now just expects to come lower. So they're kind of having a little bit less impact. But really, everyone's looking for signs in the labor market of what's going to happen with this core services inflation. And then commodities, all in green, positive carry across the board, suggesting that commodity vols kind of got a little bit expensive here, and maybe it might be worth selling in a few spots. The standout probably looks like copper right now, which has been range bound for a while. Again, realizing 14 implied nearly double that. So that's probably where there's some opportunity to harvest a bit of carry in commodities. Moving on to what's going on in terms of these macro catalysts. So we did, with the removal of this large gamma pin last week, this 30th of deck pin that the market just couldn't get away from at 38.35. We definitely think the street has got less long gamma, and especially to the downside, because that structural positioning hasn't changed. Generally, the street is going to get shorter to the downside and longer to the upside. So the gamma models out there do suggest that below 3,800, the street moves into negative gamma territory, which is therefore a higher risk. And you're likely to see more realized vol if we were to break below 3,800. Now, the upcoming macro catalysts of non-farm payrolls and US CPI next week, if they're taken badly, that could trigger that move below 3,800, and we could have some action basically back in the market. Okay, based on short-term implied vols, you can see this chart here. the CPI is being deemed to be probably the more important event here. So you've got a little spike there in the short-dated implied vol surface, suggesting that CPI is still deemed to be more important than non-farms. And that's based on recent history where you've had much bigger swings on CPI days than you've had on non-farm days in general. Now, we do think the jobs market data is becoming more and more important this year to get a read on the Fed's new favorite metric, core services ex shelter inflation. That's what they say they're looking at. And wage inflation really feeds into that. It's a big input into that. So the jobs market is kind of what it's all about. And we may find that CPI numbers, if they're not significantly different from expectations, or at least in the direction that markets expect, then you might not get as big swings, whereas job data might be a bigger driver than we think. So look out for that this week if we can get any signs from the market that might be how the tide is turning. Now, if those two macro data points do pass without any huge drama, the focus should shift to earnings, and index vols should probably take another leg down. Banks will be the first major sector to report next week. So if we were to get some macro weakness in the market and go below that 3,800 level, and you like the idea that banks might come out with okay earnings, given what rates have been doing, and given that these guys are probably making money on that yield curve, then you make the fact that certainly banks that have got deposits that are not paying their customers a massive rate, and they're able to invest those deposits into longer yielding instruments, there's a positive carry trade there for the banks, right? So in theory, the banks should do okay on that, and their earnings might reflect that. So if you like buying banks, maybe you wait for a bit of macro weakness on the back of non-farms or something like that. If we get it and you can pile into some cheap upside on the banks, that might not be a horrendous trade to be looking at. Certainly, if you're defensively positioned and you don't really own any upside, that may well be an interesting way to play it. Get some of that earnings upside on for the banks. Okay, moving on. Generally, when yields go higher, as they have done since, say, December expiry. So since middle of December, 10-year yields in the US are up about 20 basis points. They were even higher, but they've pulled back a little bit. Generally, ARK, should get hammered on the back of that. And it has come down, but it's bounced quite a bit as well from its lows. So if we look at the main holdings within the ARK basket, we can see that really Tesla and Teladoc have been hammered. So Tesla's down 25% since the middle of December. Teladoc's down 12%, and everything else is quite contained, right? It's not actually a complete disaster. So I do think under the hood, ARK is showing a bit of resilience if you just take out what Tesla's doing. Okay, you look at the chart, the weekly chart on ARK as well is showing some bullish divergence. So we are at the bottom Bollinger Bands on a weekly chart. We are showing bullish divergence. The momentum indicators are not rolling over and are starting to bounce and make higher lows, whilst the spot has made lower lows. This is often a sign of a reversal. So we do think there's a window of opportunity for ARK to have a bit of a bounce here, because there's obviously a lot of bad news priced into it. So we're looking at and even Tesla's got a load of open interest on in the money puts to January, as Spot Gamma have pointed out. If people let those things expire without rolling them and replenishing those shorts, then you may see a net marginal buyer come back to Tesla and take that stock higher, which would be good for the ARK basket as well. So I do think that ARK is potentially, looking like a setup, at least in the short term, to have a bit of a bounce. Now, I'm not trying to call a bottom in the cycle by any stretch. I have no idea how low ARK goes. Some people are calling Tesla stock down to $10 for crying out loud. So if that happens, ARK's got some room, right? And the crypto names as well within ARK as well, I don't think they've necessarily bottomed as well. So I think be careful, but I think on a short-term basis, there is a potential rally here. And whilst medium term, having structural trades that are bearish and things like ARK and in just generally in the markets, I think is right. I do think on a tactical basis, say between now and February, may well be an opportunity to buy this thing. Okay, how would I do it? The last thing that is top of mind for me right now is treasuries. Will treasuries decorrelate? When will they decorrelate? Because I think they will. But when will they decorrelate from stocks and credit? Okay, so since the inflation arrived with a vengeance last year, stocks and bonds obviously have been positively correlated, which isn't typically how they trade or haven't traded for quite some time. Now, this is because inflation was above 5%. And, Darius Dale, 42 Macro, has said many times that correlation does flip when you get higher inflation. Inflation does look like it's peaking, though, and it is heading back down. So the question is, what's going to happen with these correlations? Now, looking at HYG, which is the credit ETF, high yield credit, that's also pretty positive. So these charts show us positive correlation, and it used to be negative, but it's been going this way on both, and it's looking pretty extreme, right? Positive 50% pretty much against HYG, and a positive 30% close to that against stocks. Now, in 2020, remember when we got our big growth shock, these were deeply negative correlations, right? 60% negative with HYG and even more so with stocks. So the idea is that if you think we're going to get a growth shock this year, then this correlation should really flip, okay? And treasuries and credit and treasuries and stocks shouldn't really be moving in the same direction anymore. So I believe that this will happen. I think this correlation will flip. And the way I'm playing that is I'm selling low delta puts on TLT. I'm buying low delta puts on HYG with the premium that I receive. And because of that volatility differential that I mentioned, where TLT is quite expensive relative to HYG vol, I'm getting multiple contracts, right, of HYG for what I'm selling on TLT. So the notional I'm managing to buy on the downside on HYG is greater than the notional that I'm selling on TLT. But even without that notional difference, if the correlation does flip like I anticipate in a downturn, if this credit cycle downturn does occur later this year, you should see credit markets sell off aggressively and treasuries actually hold a bid because they catch a flight to quality, basically. So that's the trade idea. I've got that in my options overlay portfolio that subscribers will already know about, but this is a trade that I'm super interested in, and it's probably a trade that I'm going to scale into over the next month or two and kind of really grow to be one of the structural positions that I want in the book for this year, because I do think it's one of the better opportunities that I've spotted in vol space. Okay, that's it from me today. Thanks for listening, guys. Remember, like, subscribe, comment, ask me questions on these trade ideas if you have them, and I'll catch you all tomorrow. Thanks.